Good morning, everyone. It is Friday, April 11th. The market will open in about 30 minutes. It's been another rough week. We had a rough week last week. We had a rough week this week, and it became somewhat of a great day on Wednesday, but yesterday we gave up some of those gains. And today we'll see where the market goes. The futures are supposed to open up a little higher, which is good to see. The big banks announced today. There's lots of earnings from big banks, so I wanted to take a look at that, see what's going on with big banks, and go over the market overall to see where we're at. I think the trade war has cooled off a bit as it relates to every other country except for China, the biggest trading. I think it's the biggest trading partner with the U.S. and the tension between China and the US has become really high, and the escalation of tariffs is really increasing. So maybe I can comment on, who would be winners and losers in that, but trade war and relating to stocks. Which stocks are going to be hard hit if the China US trade war escalates? Because it's gotten ugly and it can get uglier unless it gets resolved some way. We had good to see you, Shadow Guy. I did see the PPI data. Inflation based on the producer price index did come down, which is good news. That means that the inputs into production are a little lower, which is very good, and could hopefully cause the Federal Reserve to lower interest rates. I think that'd be a good thing. Interest rates really climbed this week. What was interesting was there was a big sell-off in the market, and keep in mind the bond market, right, is much bigger than the stock market, and a lot of other countries own our debt, meaning they own U.S. bonds, and those countries, Japan, began to sell some of our bonds, and a lot of theorists and I think informed people, frankly, believe that's what caused the big influence on the U.S. president to put a 90-day delay on tariffs. Was once the bond market started to unravel, that was really scary for everybody, including myself. If the bond market unravels, we can go from current interest rates to like 10, 12, 14% interest rates. And that would just crush a lot of industries. That would just crush the US economy. So they kind of really slammed on the brakes on these tariffs. And they realized if they start breaking things, it might be really hard to put them back together. For sure, you can't put them back together in 4 years. It would just be a brutal 4-year presidency for the current president. So I think the minds around the president did, I think, give him the right advice, which is, hey, if you burn down the bond market, we're toast. Interest rates are really going to climb. We're going to get back to the 80s when we had interest rates of 12%, 16%. Could you imagine that? That'd be nuts. So we avoided that for the time being. Hopefully it was a lesson learned and we're not going to play around with that anymore. But for the meantime, interest rates are still quite high. I keep an eye on them for a couple of reasons. One, they affect the economy so much. They affect stocks so much. And I am a bond investor. And we're seeing rates still continue to climb. Look at that. And they've climbed quite a bit this week. And I know we're going to talk about stock investing, but the discount rate that I use on these, valuation models, that's where it comes from. Is if interest rates are very high, you have to use a higher discount rate. If you have higher interest rates, then you're going to have lower stock prices. It's an inverse correlation. Higher interest rates, lower stock prices. That's just the way it is. And you can see the climb just in 1 week. We went from 399 on the 10-year which was quoted on the 3rd. We are exactly 8 days after that, and we have climbed 48 basis points, a half of a full percentage point in 1 week. It's a big, fast climb. We've been, over the last 5 years, the interest rates, is this 5 years? Yes. So interest rates to peak, and this is where the Fed was just fighting inflation by, in essence, slowing down the economy really fast. We are climbing towards that peak that we had in 2023. And when the increase occurred, you see the increase here from 2021 to 2022, especially in 2022, you see this climb. What did the stock market do? It really went down. It went down hard. So if we see an increase in interest rates, it's going to correlate with the stock market dropping. So that's what's going on with interest rates. All right, so that's going on there. This live stream, I'm going to cover big banks, but there's so many of them that if there's a paid investor, or excuse me, a paid member that wants to look at a stock, please put it on there. I'll cover it. I'll kind of mix it in. And then if you're not a member and you'd like to buy a super chat, $5, I can analyze the stock. Or if you want to buy in bulk, $10, I'll analyze 3 stocks. I'll really go through, and the way that I analyze stocks is I look at cash flows. Except for banks, I look at book value and earnings per share. But I'll look at full cash flows. I'll look at earnings per share. We'll do a valuation. We'll really look at the stock, and I'll really slow things down. So if you would like to see a stock analyzed, please put that in the chat, and I will do so. And I appreciate everybody's support on that. Looks like we got Omar. Good to see you, Omar. Jay Zeb, good to see you. And Shadow Guy. Do higher interest rates translate directly banks' profitability? So, it depends. I think if you have rising interest rates and the short-term rates rise, like let's study that for a second. We're going to study JP Morgan, which is the gold standard, and it's a stock that I held for a long time and then sold it and switched over to Citibank. But you see that the bank was doing quite well. And then we got into 2022. We had a bad period. I think as we saw interest rates rise very fast, banks were caught with, hey, we lent out all this money at rates that we set in 2020, 2018, when rates were far lower. So the net interest margin was squeezed. Profit was squeezed. So as interest rates rise, banks will suffer. Okay. Once they get a handle on interest rates, then they can do something with them. If you have falling interest rates, they flourish. So you see that where JP Morgan has flourished over the last year. This has been a really good investment for 5 years, and I'm going to analyze this further in a little bit. So right now, interest rates have gone up, but they haven't gone, it hasn't been a trend yet. It hasn't gone up for like a solid 12 months. So I wouldn't say that it's going to hit these guys that hard. I think what's going to hit banks the hardest is going to be a recession, because during a recession, banks will not lend as much just because businesses are not investing. They're playing it safe. They're conserving their capital. They don't want to take any big chances. And but for now, if the trend is for interest rates to really rise, let's say they continue to rise and they rise 300 basis points as an example, banks are going to suffer because they're going to be caught with loans that they made and the interest rate they're charging is low compared to the new interest rate. And that's going to squeeze their net interest margin. All right. So That's what's going on there. Looking at the heat map, yesterday was kind of a retracement of we had a superb Wednesday. Well, Thursday we gave up some of those gains, especially the stocks that really went up a lot on Wednesday. Meta went down a lot. That I felt that one. Meta is my biggest position in my portfolio. Nvidia came down, Broadcom came down. A couple places to seek safety. These, health insurance payers, geez, this thing's been kind of green all week. So that's good. Consumer staples, place to seek safety, and then utilities. So genetics smite, good to see you. So looking at the sectors, right now, year to date, consumer staples, as expected, are uh, on top. And then materials keep like working certain materials. And I'm really looking into materials because they just keep showing up near the top of the scoreboard here. Utilities, healthcare, the laggards, technology, no big surprise, but they're giving up a lot of the gains they've had over the last couple of years. Discretionary down. I mean, they're caught up in the trade war. Discretionary is typically products that are being produced outside the U.S. and then sold in the U.S. Energy has really been beat up. Energy prices are really down. Communication services is, all things considered, holding up okay, down 7%. Overall, I think the S&P is down. What is the S&P down year to date? It's down 10.43%. So that's where we're at there. And some sectors are certainly ahead of that S&P number. The S&P is down by that portion because technology is such a big sector, 18 trillion. Now, not too long ago, we were like above 20 trillion. So more than $2 trillion of outflows out of those stocks has occurred in roughly a month and a half. So look at that. And that's flowing into other sectors, flowing into international stocks, cash, and so forth. All right, so that's what's going on out there. The big earnings out there were, we've got JP Morgan announced today. That's a big cap. That's the biggest cap bank out there. We'll take a look at their earnings, see what they had to say. I also kind of put together a quick table of the biggest banks and comparing. When I look at banks, I look at book value. Book value will tell you what's the worth of that bank, and you want to see growing book value. If they're growing book value, that's a very good sign. That means, hey, the bank's that particular bank's going to be worth more. And also look at PEs just to compare along with its stock price. So I'll show that to you in a little bit. I'll look at JP Morgan, Wells Fargo, Bank of New York Mellon, Citibank, and Bank of America. The other companies that announced, Morgan Stanley, BlackRock, and Fastenal, which is a fastener company. So some pretty sizable market cap companies. And so far, I think the earnings have been good, not great. Oh, and I take that back. We're now in the red. What's going on? Did the market kind of flip on me? Let's take a look. So the NASDAQ futures are still up a little bit. But the banks, I was looking at this an hour ago and it was in the green, but now we're in the red. So they had a good quarter and they guided that 2025 is going to be turbulent, that it's not going to be an easy year where, we're going to go up and to the right. It's going to be challenging. So maybe the comments they made, and they're probably just finishing up their earnings call, that's probably what's driving down the stock. So in the pre-market, they're down 1.5%. Overall, this is a very good bank. I got out of it probably about 3 years ago. And I made good money on it. I just thought that the stock had gotten uh, expensive, and I switched horses. I sold out of JP Morgan and was lighter on banks, and then I started investing in Citibank later. This bank here, I want to look at book value. Hey, Clifford, good to see you. Thanks for joining. And we've got, let's see here. So we want to look at book value. And here it is. And you see how they've grown book value. That's very good. JP Morgan is a very well-run bank, but we're seeing the book value is plateauing over the trailing 12 months. So that is one thing to keep an eye on. We see that the trailing 12 months is just slightly lower than the full year 2024. The trailing 12 months is adding the first quarter out of 2025, and we'll see how that goes. I don't think it's a trend yet. Maybe they start to accelerate their book value, but over the last 7 years or so, this has been a really good company extending their book value. So that's a good sign. And looking at their forecast, we've got analysts, 15 analysts cover the stock. $330 price target is the best price target out there. The most pessimistic is at $185 a share. So overall, they, on average, believe the bank is discounted by 11%. Looking at the combined forecasts, as all these analysts put their forecasts together, they're expecting the bank's going to grow in the single digits for the next couple of years. And they are going to expand earnings per share. It's going to contract this year. And it's interesting how quickly, the expectation of that recession's already being priced into the stock. So that's good job by the analysts. They're like, hey, they're going to have a contraction. I think there's going to be a slowdown in lending and activity for the bank. So they're going to see a reduction to their earnings per share. So interesting. But later on, hopefully, we have a short recession and then we move on. So that's where we are getting that forecast. So that's JP Morgan. It's a solid company. When I look at the banks, the banks have been, for the past year, I'm looking at JP Morgan, Wells Fargo, Bank of America, Citi, and then Bank of New York. And Bank of New York is performing the best out of the last year. Second place, JP Morgan. Wells Fargo did well, I should say, given that we're in a down market now. Bank of America is slightly in the red, and then Citigroup is slightly in the green. So that is what's going on over the 1 year. Year to date, JP Morgan's holding its value well. Not quite as well as Bank of New York is really performing well. At least their stock is performing well. We'll take a look at their earnings in a little bit. Then Citi is down 12.5%. B of A is probably taking the biggest hit. Wells Fargo's down 10%, and then JP Morgan's down 5%. So JP Morgan's held up quite well. It's a good bank. I just continue to look at the valuation of that bank, and I put together a schedule here. And what I'm doing is I'm looking at the book value per share of each stock, and I'm looking at the biggest banks. Here's Citibank, Bank of America, Wells Fargo, Bank of New York, and then JP Morgan. And if we look at price to book, the stock price compared to the book value, Citi provides the best discount, the best price to book. Bank of America, second. Wells Fargo, third. Bank of New York, the stock price has been climbing. So it shrinks, or I should say, it expands the price to book, which makes it more expensive. And then JP Morgan's the most expensive. JP Morgan is a stock that a lot of investors like to hold, so that's why they're the most expensive. PE, they're kind of all around the same amount. Citi's got the best PE, and Bank of America is right there in second place. But this one here is the more important metric that I look at when I look at banks. So that is JP Morgan. Wells Fargo, how are they doing? They're also down. That is interesting that the banks are down. And they also had a good quarter, but they're also expressing concerns that, the economy can really go off the rails and they can really suffer because of a bad economy. So that is the sentiment that these banks are communicating. Now, one of the things that I wanted to focus on was sentiment, because the banks do have a lot of influence around sentiment. They're expressing what they're seeing in the economy. If they're seeing a lot of hesitation to grow businesses, to seek loans and so forth, then they're telling us, hey, this is what's going to happen in the economy over the next 6 to 12 months. And if the banks are struggling, pessimistic, I think they're telling us, hey, we're going to struggle in 2025. We're already in a lot of fear, right? We got tariffs that are really shocking the market. Interest rates are climbing. I think there's like the travel space is really contracting. So it's showing that consumers are really watching what they spend. So those things are not a surprise. They're just basically adding to the narrative that, hey, we're going to go through a recession. So that's what's going on with Wells Fargo. Their earnings, both the earnings on the JP Morgan side and Wells Fargo, they're good earnings. Now, total revenue did contract a little bit for Wells Fargo, but their profitability was good. Their earnings went up. So they sold, I guess they recognized less revenue, but they made more money. So that's a positive. And but they're not fast growing. Neither JP Morgan nor Wells Fargo, they're not growing very fast. They're growing very slow because they're so big. So Wells Fargo reported, I thought their earnings were fine. Over the year to date, this bank is down 10%, but everybody's down over the last month and a half. So that's what's going on with Wells Fargo. Nothing big and exciting to talk about there. Oh, by the way, I don't focus on dividends for valuations, but banks do pay dividends. Wells Fargo is paying a 2.5% dividend. JP Morgan, 2.22%. I know some investors like bank because of the dividends. The Bank of New York, this is the best performing stock. And man, it's really coming down today, minus 5%. They pay a 2.45% dividend. And year to date, they're doing quite well. I mean, today they're going to have a pretty good down day, but that's where they're at there. These guys, I think they're growing the best. So it looks like in the quarter they grew 6%, and the other banks didn't grow that fast. They were growing at a slower rate. And these guys, and I haven't looked at this bank very closely. I don't know a whole lot. I've probably looked at Citibank, JP Morgan the most. But this one here, this is the best performing one over the last year. They're probably one of the smaller. That's probably the smallest of the big banks. So maybe that has something to do with it. So Bank of New York down 5%. And in addition to the big banks, we've got BlackRock announced their stock is trading down a little bit, minus 0.67. And that CEO is talking about uncertainty and anxiety. So those comments are I think they're going to influence the market overall. BlackRock is not a bank. They're more a private-owned investment manager. The firm primarily provides its services to institutional, intermediary, individual investors, including corporate, public, union, industry pension plans, insurance. So these guys do bigger deals and probably, or it's more of an institutional lender, private money kind of organization. And they're a pretty big organization, $133 billion. They do pay a dividend. Forward P is 18. So the PE is higher than those banks because these guys probably grow a little better and actually a lot better. So the growth is really good year over year, but they did have a contraction in 2022 when there was less going on from the companies were in a drawdown, so they weren't investing a whole lot. So BlackRock did see that. If we go into a recession, BlackRock is going to feel it. They're probably going to feel it much more than a bank. Year to date, they're down 16%, and 1 year they're up 6%. So BlackRock is down 0.76 after announcing their earnings. And then Morgan Stanley, to kind of finish off the big earnings of the financial space, they're down 2.56%. All right. These guys pay the highest dividend, 3.5. Year to date, they're down 15%, and they're doing well over the 1 year. They had a very good year last year. And I think it's because the market did so well, right? Morgan Stanley is a financial holding company, provides financial products and services to governments, financial institutions, and individuals in the Americas. So they do a lot of wealth management. They do a lot of those types of services. The stock market did really well last year. So they probably had a lot of fees to charge. And their customers were probably really happy with, hey, my returns are great in 2024. I'm going to put more money in. But now that we're really feeling it, really feeling that drawdown, they're feeling the drawdown as well. So there was a lot going on in the financial sector. It's interesting that it's down. I thought it was going to be up. I was looking at the stocks, just kind of seeing what was going on with each, and everything was green about an hour ago, but it has turned red. So that's what's going on there. And then the last one is Fastenal. And these guys do fasteners. They're down a little bit in the pre-market. And I expect that this is an industrial company. They're selling into a couple of different ways wherever there's manufacturing, building, and so forth, you need fasteners. And these guys, that's what they do. So I imagine they're probably going to go where the economy goes. If the economy contracts, they're going to contract. It's interesting that year to date, they're doing okay, plus 5%. This year, that's a win. And for the 1 year, they're pretty much at even, which isn't bad considering that this year we've had a pretty significant drawdown. Now, I'd be interested to know how big of an impact is the whole China. Do they source a lot of their product from China? So that'd be interesting to know. I've looked at this company in the past and it just didn't really excite me. It's a $43 billion market cap, revenue $7.6 billion. So you're paying about, let's call it 6 times revenue for the company. They have a high PE, considering that they're not a high growth company. See, it's a slow growth company. So you're paying a high PE. You're paying a higher PE than like Microsoft. And Microsoft's growing at 20%. So that's interesting that they get such a premium valuation. And we look at cash flow, it's not really growing. If you look at their cash flow, it had a nice growth, 2016 to 2020. But then after that, we had a contraction in 21, 22, and then a rise and then a contraction. So cash flow isn't showing an upward trend. It's actually trending downward. So that is not overly exciting. Even if I used an average of, let's say, $1 billion, saying that they're thinking that optimistically they're going to do about $1 billion. The best valuation I can give these guys, and let me look at their debt level. Okay, so they don't have too much debt. They only have net debt 264. They're probably worth 15 to 20 billion in my book, and they're priced well above that, so much higher. So I'm not going to pay a huge premium on a business like this. I'd rather own 3M. I think it gives me a way better price to potential reward, and how risky is the stock. In this stock here, it's been doing well, I think, over, let's look at the 5-year, see if this thing can update. Yeah, it's done well over the 5-year. It's a good deal for investors that have been there for 5 years. But again, I like 3M more than Fastenal. This company is a solid company, but it's priced really high for what they are. Slow growing industrial company. Their margins are okay, but it's not an overly exciting stock. Every time I look at it, I come with that conclusion. So let me check comments here. Clifford, good to see you. Sabir, Brandon, good to see you. Thanks for joining. And I think I caught up. Perfect. So if you'd like me to look at a stock and you want to buy a super chat for $5, I can look at a stock and we'll go through, we'll do a valuation of it. And if you're a paid member, just put it in the chat. You don't have to pay anything additional. Just put it in the chat and I can look at it. All right. So let's take a look at the markets. I think they just opened and see what's going on. So the markets did open in the red. And for the year to date, geez, so we opened in the red, and year to date, we are down 15%. And from the recent high to where we're at now, we're down 18% on the NASDAQ. We had that really nice day a couple of days ago. We gave up some of those gains, but it was still a really good day. And here we are. Now, it's going to be kind of expected in a bear market. You have these bear market rallies where stocks will rally, especially as some investors see those low stock prices and they want to buy in. Makes sense. I've been buying stocks in all these, sell-offs. Stock prices have been depleted. I know the companies I want to own. I've been buying into these stocks. And today is not a really down day, but I'll still maybe nibble a little bit on some stocks. But on those really severe down days, it makes it very obvious that I want to buy those stocks. So I've been a big buyer as we've seen this big sell-off. As we approached the new year, around this time frame here is when I was nervous that the market was too expensive, and I started selling some stocks to build up some cash. And I'm glad I did so. I came into the new year with some cash, and I've been able to use it as we've had this huge drawdown. Now I'm beginning to get a little light on cash. I'm not out, but if days like these occur all the time, I'm going to be out of cash. When you have the NASDAQ go down 11.44%, yeah, I bought a lot on that day. So we'll see how things play out. But if I run out of cash, I'll just sit tight and wait for the market to come back at some point. I'll have to get creative on other ways to create cash to buy into this correction. The sources I'm looking at is I have some bonds that are maturing, and I also have some bond ETFs that I can sell quite easily. So that'd probably be a source. And I've also been selling some of my Bitcoin and Ethereum. I'm sitting on big gains on Bitcoin. And it does feel, as I get older, I need to start thinking of reducing risk. And the Bitcoin investment has played out really nice. 2018 to now, very happy with the return. But I can reduce risk and, invest in this drawdown. This drawdown is an opportunity. When we see markets like this, it is a big opportunity disguised in a really scary costume. The costume of fear. Like these things are real, right? The trade war is real. The tension, the potential recession with people losing jobs and so forth, some businesses going bankrupt. All that's real, but it creates an opportunity like it did in 2022. And that opportunity is for me to invest further in these businesses that I really want to be an owner in. I invested during this period, and I'm so glad I did. It started to work again, and it took us about a year to get through it. And it's been a really, really, really good thing. Now, the one thing that's different about this particular drawdown and the one that we experienced in 2022 is how fast we've gone down. It's like, geez, we've gone down fast. I mean, in the first couple of months, of the drawdown in 2022, we went down like 7%. Well, we're way ahead of that. It took us a while to get down about the level that we're down now. So I think we're going down faster than back in 2022. So we may have a quick path to getting to a bottom, and then we'll see the market maybe stabilize and not start to appreciate very fast, or maybe it will. We'll see. We'll see if we get some good news. But it's not going to be a perfect repeat of 2022. But I'm just kind of comparing it since that is the most recent drawdown we had in the market. So right now, the NASDAQ is pretty much flat. The S&P is down a bit, and the Dow is down. Those banks are probably represented in the Dow. Looking at the heat map. NVIDIA is up. Oh, man, so semiconductors, some of them are working today. That's interesting that that's working today. Google is up. All right. Tesla's up. Apple is down a little bit. Meta is down. So we just have a couple of stocks working, and it's a couple of the big ones are working today. Netflix has really endured this drawdown quite well. A lot of people treat Netflix as kind of a consumer staple, and I can understand their feeling about it that way because nobody's going to cut their Netflix, service, right? It's kind of the probably the most common paid for streaming service that you could have. So people treat it that way. The communication stocks are looking that way. Looks like Shadow Guy CB is down, huh? Interesting. So CB is Chubb, and it's been enduring this drawdown well, if I recall. Yeah, I mean it's slightly in the green, which again this year that's a win. It took the recent drop quite hard, but it was doing quite well for a while. It's down 1.62%. But overall, I think Chubb's a terrific company. I'm actually buying into Chubb on weakness. So I'd probably buy some shares today. We'll see. I'm not going to trade today until late in the trading session. My fear is days like this, they open and they're kind of close to even. But late in the day, you could have a sell-off, and the sell-off can really get nasty. So I'm not going to buy until late in the trading session. The only thing I would do early these days is I am trimming back a stock or two, kind of trimming back to create some cash. As mentioned, I'm selling Bitcoin, and I'm picking spots where, that one stock I'm focused on, and then the Bitcoin have spikes, and then I sell. But to buy at these levels, I'm not quite sure what the market's going to do today. And it's been so volatile, it's conceivable that the NASDAQ sells off by 2, 3, 4% as a whole. And some stocks would sell off potentially at 5, 10%. Well, I'd rather wait to see what the day's going to be like and then make my decisions. So looks like JPM is back up. Interesting. Look at that. Well, maybe that'll kind of spur everything else going back up. So here's the 5 different banks. It looks like JP Morgan's the only one that's heading north. Bank of America's not in a bad spot. And Bank of New York's down the most. Citibank is down. Wells Fargo's down, but JP Morgan is up. Interesting. It's the one that's up out of the big banks. All right. So let me bring up one topic that I would say is beginning to get interesting, right? We have the trade tension between the US and China escalating. And I don't know what's going to happen there. I don't know if they're going to figure this thing out and we're going to have this thing in the rearview mirror in a week, in a month, in a year. But let's talk about the businesses that stand to lose a lot. First one is Apple. Apple really depends on China for their manufacturing, and they cannot move that manufacturing, on very quickly. It would take them years, and the manufacturing capabilities of China are quite impressive. I mean, just look at what they assemble iPhones. They do all kinds of stuff now. That's pretty impressive. So they have the know-how, they have the ability. And when I think about like the smartphone market, obviously the iPhone is super successful and popular. I own one. But if it gets really bad, and let's say iPhones, instead of costing $1,000 a piece, and Apple was trying to introduce a phone that would be priced at $600. This was like 2-3 months ago to get units up. And now I think that is going to be not possible if their pricing goes up. But if the price of the iPhone really goes up, let's say a $2,000 iPhone, the competitors to iPhone, and I'm not talking about the US market, I'm talking about somebody in Latin America buying an iPhone. Why would they pay $2,000 for an iPhone when they can get an Huawei or a Samsung for like $200? It'd be ridiculous to pay $2,000 for an iPhone. So Apple's going to be in a growth. They already have a growth problem. They're going to have a contraction problem. If this thing really gets nasty, Apple stands to lose a lot. I think it could be quite hostile. The U.S. could start treating China-based companies that are traded as an ADR here in the U.S. I have seen comments that, is there a potential for that to happen? Anything can happen. I mean, we've seen some pretty provocative moves from governments these days. Now, if that happened where they banned ADRs from China into the U.S. market, it would really hurt Chinese companies that are their valuations for the companies that are listed in the U.S. I think that's a rational conclusion, but it would just, start another cycle of conflict. Let me open up a screen and then I'll finish my thought there. So most definitely we would see, if that was the case where, hey, as a U.S. investor, I can't buy BABA anymore, that would just crush the stock. It would just bring it down. And this is a pretty expensive stock, right? It's up to 239 billion in market cap. And it would crush everything that's listed on here because they're no longer going to have investment from the U.S. But I am certain that China is probably going to retaliate and make it even harder for Chinese for American companies to do business in China. It would get nastier if that were the case. So hopefully that doesn't happen, because I think the tariff war is bad enough where you having the level of tariffs that China and the US are establishing. I don't see how that's going to work. I mean, that's going to increase the cost of so many things that are consumables here in the US. You think about the Chinese products we go to Walmart or Target or Costco and buy. I mean, it's a lot. I look around my home and there's so many Chinese products in my home. And it's not that I try to buy Chinese. It's not that I don't try to buy this or that. I go to my store, and when my family needs something, I go buy it. When our home needs something, we go buy it. And it ends up being made in China. Well, if you all of a sudden double the price on products, I'm not going to buy it or my budget's going to be squeezed, and the average consumer, their budget's going to be squeezed. So those things are going to get pretty nasty if the current tariffs continue on the course that they're on. I'm not a political guy. I'm not a political scientist. I'm just a guy. I'm just an investor. I just expect that, it's going to get nastier if the tariffs stay out there. So it looks like the market's gone to the positive. Shadow guy. It wouldn't entirely shut it out. You could still buy in the Hong Kong exchange. You might also open up Shanghai exchange to foreigners. That's a good point. But it would, I think it would cause a sell-off, because, I'm probably more advanced than the average investor, and I'm not comfortable going to foreign exchanges and putting my hard-earned money in foreign exchanges and so forth. I feel there's a sense of assurance when a company, especially these ADRs, have to report using the reporting standards of the US, and the SEC forces these companies to report. So there's a level of implied trust when a company like Alibaba, they stand the risk of being delisted if they report inaccurately or if they don't follow the rules. Well, if you take that stock and put it in a foreign exchange, I'm just not familiar with the rules that they have for accounting, for reporting. I'm not familiar with that, and just a higher risk. Maybe not for every investor, but for this investor, I'm like, hey, I like investing here in the US. And, this is where I lived my whole life. This is where I know the accounting standards. And so I'd rather invest here. And when you have a foreign company come to the US and be listed, and then they have to report according to our standards, it makes me more comfortable, and it enables me to analyze companies better. So I would say that, if you delisted those companies from the American exchanges, it would hurt the overall investment in them, because guys like me would probably not invest. Like, I had a chance to invest in Nintendo. Nintendo, it's a huge name, right? But you can't buy it on the US exchange. You have to buy it in the Nikkei. And I went through all the hoops, and the transaction cost was high. I think it was $50 per trade. I'm sure I can find a better deal somewhere out there. But then I thought about the risk, right? Which is, well, if I'm having that much trouble buying it, then what's the overall demand of that stock? I'm sure a lot of people in Japan appreciate the stock. That's great. But it'd be far better if Nintendo, was listed here in the US, because they'd get that much more investment. I think it'd be good for the stock. Maybe someday they will. But that was my one experience I've had a couple experiences trying to invest in other exchanges, and I just decided not to. So, all right. So markets are up. Looks good. S&P is up. More green on the heat map. We've got NVIDIA's up, Google's up, couple of the pharma companies are up. Tesla's up. All right, looks good. Let's hope it continues to rise. We looked at the Chinese stocks. How are they doing? I guess I talked about them, but I didn't really look at them. So BABA's up a bit. I see a lot of green on today's change. That's good. All right, looks good. And looking at the sectors, so materials is up. Man, I keep seeing materials, doing well this year. And doing well means they're not losing a lot. They're doing okay. Communications is up. That's probably Google in there. Energy's up a little bit. Technology, healthcare. Okay. All right. Not a big move day. It's we've had plenty of those over the last 2 weeks. So it would be nice to have a day where things are a little calmer. Google's Nvidia's leading the big stock kind of board here. Nvidia's up 2.17, and then Google's up 1.96. Broadcom's up 3.42. TSM. So the semiconductor space is in rally mode. Interesting. Okay. All right. So let's see here. Yeah, you make a good point, Shadow Guy, that, sometimes situations like this, and if you break something, somebody else fixes it and they take the market, right? So maybe if it got contentious and it got really nasty, maybe it does compel investors to start looking at foreign markets and finding a way to invest in them, because the American market has been really expensive. It's had a drawdown, but it's still expensive relative to other markets around the world. So maybe it does create a new opportunity. So that you make a good point. Very good point. All right, guys. So before we conclude, let me invite you to join the channel. If you go to my homepage, if you're interested in joining, and you click on the join button, you'll see the different options of joining the channel. It'd be great to have you. There's good perks involved. You can come to member calls. I offer up the tools that I use in a Google Drive. You can look at the analysis that I perform on a monthly basis. I have a copy of the analysis that I've done on each company. You can search up companies and just use it as a reference point. The model that I use when I value companies, you have access to that. I even put a retirement model in there. So take a look. It'd be great to have you guys as members. There's Shadow Guy's a member. I appreciate that. And it'd be great to see more members in there. We're really growing the number of members, which is great. And it'd be nice to have more. So that way we have more people contributing to the live streams and so forth. And this will probably be the agenda that I follow during the earnings season. We'll handle the earnings there's going to be a lot of news coming up during the earnings season, where if you look at Mondays are usually kind of slow, so to speak. We do have Goldman Sachs, but then we are going to get going. We have Johnson & Johnson, Bank of America, Citigroup. We have some big names, and it's just going to get bigger. TSM, United Health Group, Netflix, and on from there. It's going to be really, really interesting for the next month, 6 weeks. So I'm going to be handling a lot of the earnings on the live streams. I try to live stream as often as I can. And then we'll go over the members that have become members, paid a monthly fee. We'll go over stocks they want to request, and then we'll go over super chat requests, and then we'll go from there. So that'll be kind of like what we cover on the live streams going forward. So everybody, it looks like looks like we're good to go. Everybody enjoy the day. Hopefully the market stays in the green and we all see our portfolios go up a little bit because it's been a rough 6 weeks. So it'd be nice to have a decent day, a nice smooth day. Everybody take care. Thanks for joining.